I'm Lee Scully. I'm an associate investment advisor with Bishop Cross Border Investment Services. Today I had a conversation with Sam Kyriazis and Gary Chow, two Raymond James cross-border tax planning specialists. Sam is based in Toronto and has 15 years of cross-border tax planning experience, and Gary is based in Vancouver with over 20 years of cross-border tax planning experience. We had a great conversation. We covered the do's and don'ts of tax planning when you're planning to move across the border. We talked about the differences in tax systems and the interplay between them. We talked about common mistakes to avoid. We also talked about specific scenarios, such as inheriting U.S. assets as a Canadian resident, and how to plan the sale of a U.S. property while also planning to move and declare Canadian residency. Everyone is unique. Everyone has different scenarios. You should plan well enough in advance so that you avoid costly mistakes and have peace of mind as you move across the border from a tax perspective. I hope you enjoy my conversation with Sam and Gary, and as always, please reach out if you have any follow-up questions about the discussion. All right, we are June 4th, 2026. Sam, you're joining us from Toronto, Gary from Vancouver. Really appreciate having you both on. As you know, we have a lot of cross-border clients who ask a lot of tax-related questions. So I think it's really prudent that the three of us are meeting, and hopefully the clients that watch this will get a lot out of it. So really appreciate you joining.
No problem, Lee. Happy to be here.
Great. Let's just jump right into it. Maybe we'll start with some basics. So Sam, maybe I'll begin with you. Just generally from a high level, for someone with ties to both countries, Canada and the US, whether they've moved here, they're planning to move here, or vice versa, what are some high level tax planning considerations? What's important for those people to think about?
It's a good question. So the first thing, the most important thing is to sort of understand, the tax residency rules and how the individual sort of is considered, tied to either Canada or the U.S. And that would be dependent on the residency rules. For Canada, which are a lot different from the U.S. Their system is based on citizenship or green card status, which is a lot different from Canada. And depending on your ties to either Canada or the U.S., it could have significant tax implications depending on the assets the individual holds due to the differences in the Canadian and U.S. tax systems.
Yeah, exactly. And I know there's a lot to unpack there. That's a good starter. Gary, just curious about what you do. What kind of people do you normally see seeking this kind of advice? For us, it's often, families, retirees, business owners, professors, dentists, you name it. Is there a certain profile you often see, Gary?
The profiles have changed over the years. I've been doing this for a very long time. Historically, we've seen a large number of Canadians head to the United States, primarily for job opportunities. But what's happening now is we're seeing a large inflow of American citizens or former Canadian residents who are still Canadian citizens and perhaps are now dual U.S. citizens as well, coming to Canada. And we're seeing lately, I was mentioning the other day to Sam, at least one medical professional a week coming northbound. So things are changing very rapidly.
Wow. Yeah, we see that on the East Coast too, here in the Atlantic provinces, especially like you said, medical physicians. That's certainly increasing. Okay, let's address some basics. So Sam, maybe back to you. Could you explain at a high level each tax system generally and how they differ from each other from the perspective of someone who has tax filing obligations in both countries?
Yeah, certainly. So both tax systems, as I mentioned earlier, are a lot different in terms of the tax implications based on your tax residency status. So if you're a U.S. person, that would be considered either a U.S. citizen, or green card holder, or a resident of the U.S. You'd have to file a U.S. tax return subject to U.S. taxation on your worldwide income. If a U.S. person were to move to Canada, because U.S. has citizenship-based taxation, if the individual is still a U.S. citizen or a green card holder, they would still have to keep filing a U.S. tax return in Canada, and by virtue of the fact of their U.S. status. On top of that, they would also still have to file Canadian tax return because Canadian tax residency rules and your ties to Canada, if you have a home available for you in Canada. If you're living and working in Canada and your family is moving with you, you'd also likely be considered a Canadian tax resident. So this complicates things quite a bit whenever you have to file in both jurisdictions, and you have, various income sources, because of the fact that the CRA and IRS don't always tax certain investments the same way. So it's important to understand, number one, your U.S. tax status, as well as how the laws in both Canada and the U.S. treat various sources of income, and to avoid, double taxation. Canada and the U.S. do have a tax treaty, so it's important to understand the tax treaty and the interaction between the two systems.
Right. And Gary, maybe could you just working off what Sam mentioned about the tax treaty, could you talk about that and how that generally works, and what parts of that we can take advantage of for people that need the cross-border advice?
Well, the tax treaty is a very interesting beast. People always think you need to go to the treaty. I always say, look, you need to look at your domestic law first, either in the U.S. or in Canada. But if you're subject to taxation in both countries, sometimes you may be taxed on a particular item in both countries. So you look to the treaty for relief, so you don't get double taxed. So basically, the treaty, for example, you look to, for example, Social Security, which is quite common. American retirees coming northbound, retiring here in Canada. And basically, for example, the treaty says Canada has the taxing rights on that. So where you're subject to tax on income in both countries, you use the treaty as your friend for relief.
Right. And what are some of the underlying mechanics of doing that? And I'm thinking specifically of things like foreign tax credits. Could you speak to things like that and generally how those work?
Well, foreign tax credits are actually calculated based on domestic law, both in the United States and in Canada. So, but what the treaty does is it actually says who has taxing rights first and what are withholding rates. So the foreign tax credits are actually generally dealt with under domestic law.
Right. Okay. And this is all really good information. I think the first thing people really have to figure out is what determines their tax obligations and their residency status, for example. So, Sam, you mentioned the US taxes its citizens, Canada taxes its residents, and there is often a scenario where you have obligations to both. So, in this specific scenario of someone moving from the US to Canada, what are the specific things that dictate or establish Canadian tax residency for tax purposes?
Um, so for under Canada's domestic rules, typically what the CRA would consider, in terms of if you're considered a tax resident or not, they would typically look at what's called your primary ties, and primary ties would include things such as if you have a home available for your own personal use, whether it be owned or rented, as well as where you have any family members residing. That would include a spouse or any dependent children. If it's not clear based on those primary ties, if you still have ties to the U.S., they would also consider secondary ties as well, such as where you spend the majority of your days, where your employer is based, where you have, let's say, healthcare insurance, driver's license, financial accounts. In addition to that, they also look at what your intent is. So if you're intending to stay in Canada for, a long period of time, or if you're just in Canada temporarily for let's say a 1 year contract, those factors will all be looked at in terms of considering whether someone is a tax resident or not of Canada.
Right. And what are some things that are important to track? For example, the day you land here, the day you might leave the country or come back, like timing is very important. So are there any other things that are really important to have clear records for?
Yeah. Typically, the date that you physically move all your personal belongings and no longer have a home available for you in the U.S. You typically be considered a tax resident of Canada as of that date. So it would be important to sort of keep record of that date, as well as the value of your investments when you come to Canada. If you're traveling back and forth, let's say to Canada and the U.S., you would want to make a good record of your travel days or work days in both jurisdictions, in order to make it easier to determine your tax residency status, if the CRA were to sort of look at your residency situation.
Right, exactly. And Gary, maybe I'll ask you this one, which really is related to this discussion is a lot of people ask us when they move here, what are the implications of renouncing US citizenship? For example, if they're now physically here, they have a residence here, their lives are now here, oftentimes they question whether they should keep ties with the US at all. Some people prefer not to for their own personal reasons. So, and people do hear about an exit tax, and I don't think a lot of people understand what's involved there. Could you elaborate on that a bit, Gary?
Well, I've had a number of clients over the years who actually expatriated, and it's actually a quite a long and challenging process. It's harder than you would ever think to actually give up your U.S. citizenship. That being said, care must be taken when you do that because the U.S. has an expatriation tax, which you refer to as an exit tax. And if you're a covered expatriate, which is a complex definition, yes, they'll take a look at you'll have to file Form 8854. They'll take a look at what your assets are. Do you hit the $2 million USD threshold? And so you will be paying tax as you leave if you're one of these well-to-do people. And so you really must ask yourself, if you're considering this, are you subject to the expatriation tax? And do you really want to go through the process and pay that tax? That's what it
Right.
comes down to.
Do you find that most people that first bring up the question follow through with doing that, or do most people decide that it's so complicated and expensive, or is there a mix?
There's a mix because I've seen a number of well-to-do people who are subject to expatriation tax, and they realize, well, hang on a second, maybe I'll just keep filing these U.S. returns because I don't want to pay the tax.
Right,
Like, why pay
right,
tax if you don't have to?
exactly. Yep, that's right. Those are all great topics that we could certainly elaborate on. I do want to talk a bit about the common pitfalls, some common mistakes that we often see. I have a bit of a list here. I'm going to run through it, add your own, elaborate on what I talk about because I'm sure there are things that I'm not mentioning here. But for example, when people move here or there's a cross-border situation, not filing the required U.S. returns, so FBAR, FATCA, filing dual returns improperly, not understanding departure tax, improper estate ownership structures, contributing to U.S. registered accounts as Canadian residents. That's one we often luckily catch upfront and advise against. Holding problem investments like PFIX. Sam, you and I had a discussion about that recently. So passive foreign investment companies, that can include things like Canadian mutual funds, Canadian ETFs. A lot of people are unaware of that specific stipulation. Not understanding gift tax reporting requirements and estate tax exposure. So a lot of people are inheriting U.S. assets or gifting assets to people in different jurisdictions. So I'm going to pause there. Do any of those stick out to you as the most common, the most expensive, the most complicated? I'll give this to
Um,
you, Sam.
yeah, sure. Yeah, so I think, you've touched on a lot of really good points. So these are all sort of important filings that if missed, can result in significant penalties that the IRS could potentially impose. So I think the number one rule, if you are a U.S. person moving to Canada or vice versa, is to work with a good, cross-border accountant as well as financial advisor that's well versed in cross-border, financial planning and taxation. Um, because it's easy to miss a lot of these forms that the IRS has, that Canada doesn't have. Canada doesn't have a gift tax where the IRS does. So each gift that you make to, let's say a family member or potentially a spouse could entail having to file a U.S. gift tax return, and there's significant penalties for not doing that. Whereas in Canada, they don't have such a filing. Additional filings if you have certain investments, such as Canadian mutual funds and ETFs, require IRS disclosures and additional filings. So it's important to sort of, stay on top of these filings and understand them. And, the average Canadian based accountant would likely not be familiar with these rules. So it's important to have, either US based or ideally cross-border accountants that can understand the interaction of the two systems to be able to file your tax returns correctly. Number one, not miss the required filings, and number two, to make sure the filings are correct. So the income that you report, let's say from your U.S. investments or U.S. employment income on your Canadian tax return is recorded correctly, and you're claiming the foreign tax credits correctly in both jurisdictions. So you're not paying any more tax than you have to, and not getting double taxed.
Gary, did you have anything to add?
I think the most important thing to remember is that all of the points that you touched on are important. Not one item stands out. I think the biggest challenge for Americans living in Canada is actually finding a good cross-border account. There's a shortage nationwide. That's the huge challenge that people really face. There are people who say they know how to do the work, and quite often they don't. So people need to do their homework, and unfortunately, they do need to be prepared to pay. Because of lack of supply and high demand, rates go up.
That's exactly right. And I always stress the importance to clients that ask me about this of having someone who does understand both jurisdictions. Not, for example, some people might already have a US accountant and a Canadian accountant, so two different entities and professionals. Those two people might not understand the overlap and the integration. So I always stress that it's important finding someone who's cross-border competent, which again, like you said, is few and far between. Luckily, we have some really great folks like yourselves in-house, and there are also a few local groups here on the East Coast, but again, they are a rare breed. I do want to call out something we just talked about, Sam, the PFIC rules. So PFIC, Passive Foreign Investment Company. Can you touch on that briefly just for people who may not be familiar with that? Because that's one that's easy to get overlooked. That's one that most people aren't aware of, and that's one that can cause some significant issues. So maybe if you could elaborate on how that works.
Sure. So generally speaking, the IRS has these rules around um, foreign passive investments that are considered, passive foreign investment corporations under certain IAS rules, which typically are viewed as Canadian ETFs or mutual funds. They fall under this category in most situations. If you hold these investments in a non-registered investment portfolio or in a TFSA account, there is additional IRS reporting that's required. So there's additional costs to do these filings, which in my experience, accounts can charge anywhere between $200 to $500 per each individual mutual fund or ETF you hold to do this filing. On top of that, the income that is taxed for IRS purposes is not treated the same way as it is for Canadian tax purposes. So typically the income doesn't retain its character, and oftentimes instead of having the income taxed as a dividend or a capital gain, for Canadian purposes, for IRS purposes, it would be taxed at ordinary income rates, unless you make certain elections. There's different elections that can be made with the IRS. You can make, they're called a QEF election or mark-to-market election, which can allow for the income to be taxed more favorably. However, this, involves additional work for your accountant to do. You would have to get, certain statements from the mutual fund companies and do these IRS tax filings, which is an additional cost. So, ideally you'd want to avoid this, additional administrative burden and, not hold these types of investments if you are considered a U.S. person, or you could hold these investments in a Canadian RRSP account. If they're held in an RRSP account, they would be excluded from these filings. So there's additional planning that you'd have to make sure to see if it makes sense to hold these types of investments for a U.S. person in Canada. Ideally, as an alternative, you can hold U.S. listed ETFs. They wouldn't, fall under this category, or individually listed stocks and securities, either Canadian or U.S. stocks. If they're just individual stocks and not part of a fund type structure, they wouldn't be subject to these filings as well.
Exactly. That's a great overview. I want to move on to the next topic or batch of topics which are somewhat related. So people who move to Canada that have previously or currently own and operate businesses. So things like S Corps and LLCs. And then also people that own real estate, whether they plan to sell it, whether they've already sold it. Those are two very big topics. A lot, we come across those situations a lot. So maybe Gary, do you have any general thoughts or advice for people that do have LLCs or S corps that maybe they want to continue operating a business? They become a Canadian resident. What do they need to think about and what applies to them?
And people need to remember that although we're so close, in some respects, we're so far. The Canadian and the US tax systems are not designed to be the same, and they never will be. So in the US system, you have these flow-through type entities such as LLCs and S corps, which totally do not exist under the Canadian system. And when Canada looks at this, they take the position that these are actually corporations. So it does cause a problem in the sense, in terms of timing of income and the potential for double taxation. So the advice that we always give to people is, where possible, but and if you know you're going to be moving to Canada, whenever possible, restructure or wind up these flow-through entities on the U.S. side, because you don't want to be subject to double tax once you arrive in Canada. And sometimes it's a hard message to deliver, particularly with LLCs, which are very, very common in the United States. And people are somewhat surprised that they're saying like, "What? I can't have one." And I would say, no, you can have one, but it's just going to cause you a lot of tax grief. So you need to sit down and think, and plan with somebody who knows what they're doing. How can we get around these issues and still operate a business while I'm living in Canada? That's what they need to determine.
Exactly. And so, what are some of the possibilities or alternatives in the Canadian landscape? For example, running or operating as a sole proprietorship versus incorporating. Can you speak to the Canadian side of running a business?
Well, the easiest thing to do is to run as a sole proprietorship. But again, though, you'd have liability issues here in Canada. And so
That's
you
right.
have to think, okay, well, I can run it through a corporation. Well, what is that corporation? It could potentially be a controlled foreign corporation. Then you're subject to the U.S. Additional U.S. tax burdens. For example, for a controlled foreign corporation, it used to be called guilty. You can have net tested CFC income, which is the new term. And then you have all kinds of new reporting requirements, possibly the additional tax to pay on the U.S. side. And so there's no one easy answer here, Lee, because ultimately people do need to make a living.
That's right. That's right.
So sometimes you have to bite the bullet and say, hey, okay, I got to make a decision here. I got to deal with the taxes, but I do need to make a living. It's not as if you're going to close down your business.
That's right. And I would stress that it's always case by case and everyone needs their own unique advice. And you should plan ahead. Obviously, that's always prudent. Sam, I want to pivot to you and talk a bit about real estate because that's one of the most popular things we come across, particularly people that live in the US and own a home there and are planning to move to Canada. What are the general implications of the timing differences there? So, for example, moving to Canada and then selling the house versus selling the house and then moving to Canada. How should people plan for that?
Yeah, we do see that for a lot of our clients as well. Oftentimes, there's a lot of different factors to consider. One of them, the first, I would say main issue is the issue of tax residency, and having a U.S. property still could still consider you could still be considered a U.S. tax resident if you still own the property and you're living in Canada and you're traveling back and forth. So one of the main reasons why you'd want to ideally give up the property on or in or around your move date is it's to sort of cut those residential ties. Even if you have a property in Canada, depending on the laws in a particular U.S. state, you could potentially be seen as a U.S. tax resident. For example, if you have a property in certain states like New York or California, and you travel back there could be additional layer of state taxation. So it's important to sort of sell the property ideally, or to avoid potential tax residency issues in particular states. Another issue is that if you do move to Canada and you own a U.S. property, it could potentially be subject to Canadian taxation, and you might not be able to get a principal residence exemption. Um, the property for Canadian tax purposes would only be taxable on any gain that accrues while in Canada. So there'd be a step up in the cost base equal to the fair market value of the property on arrival to Canada. You would need a appraisal in order to establish the cost base for Canadian tax purposes, and reporting that in Canada, which is a little bit more work, as if instead of just selling it prior to moving to Canada, then it wouldn't be reportable at all for Canadian tax purposes. The other issue for U.S. tax purposes, in order to get the U.S. principal home exemption, which the IRS has, it's 250,000 or 500,000 if you file jointly. You have to have lived in the property for a minimum of 5 years to be considered eligible for that exemption. So if you move to Canada, let's say, and you decide to, rent it out for a few years, if you don't, if you've never lived in it for 2 of the last 5 years, you might not be able to get the full principal residence exemption. So it's important to sort of consider that as well if you do decide to keep the property and rent it out. So there's a lot of different sort of factors that we would need to consider depending on the individual's circumstances, and also their U.S. status. If they're non-residents of the U.S. and they're not citizens, and they were only in the U.S. under a work visa, there's additional withholding requirements as well. If you're not a U.S. person and you're living in Canada, they're called FERPTA withholding requirements, which requires a holdback of a certain amount, 15% of the gross value of the property, and then you have to wait to get that refunded back. So a lot of different issues that should be addressed well before you actually decide to sell the property.
Exactly. Well before. So planning's key. Same topic, couple follow-ups. So what if I'm someone who has a cottage in a US state and I want to keep that? That's one scenario we come across. And then the second one would be if I'm a real estate investor, let's say, and maybe I have a few residential properties that I'm treating as rental properties and I'm earning rental income. Those are two things that we've come across. I'm wondering what your thoughts are generally and what people need to think about and plan for there.
Yeah, just I would say, be aware of if you have some rental properties, making sure that you're reporting that rental income on your Canadian tax return, as well as filing the required U.S. tax returns, both federally and, depending on which U.S. state, any U.S. state requirements. Claiming the foreign tax credits, if you're paying U.S. tax on the rental income, we can claim foreign tax credit on your Canadian tax return, so you're not getting double taxed. So it's important to report that income in Canada as well. Some individuals think, oh, it's a U.S. property, I'll just have to report that income on my U.S. tax return, but it's also taxable in Canada as well. So understanding the interaction of the two different tax systems. If you have, let's say just a vacation property, you know, there might not be any, there's no rental income that you have to report. But if and when you do sell the property, you'd have to make sure you sort of understand the tax implications, from both Canadian and U.S. perspective. Having a rental property also entails, getting, if you're not a U.S. person and you have a U.S. property, you have to get an EIN number, which is a U.S. or IT number, which is a U.S. tax identification number. If you're not a U.S. person and don't have a social security number. So there's a lot of additional paperwork that you have to be aware of, and it's important to work with a good cross-border accountant that's sort of on top of all these rules. If you do have, rental income or selling your property, otherwise there could be additional, headaches later on, if you've had the property for a few years and you haven't been up to date with your filings.
I'm going to jump in here. I think what's important to differentiate here is whether you're a U.S. citizen who owns these properties in the United States, or if you're, for example, a Canadian who owns U.S. rental property in the States. Those are two very different scenarios with different tax treatments. So different people are treated differently.
Yeah, that's a good point, Gary.
It's a great point. It speaks to, again, how people need their own advice. Every case is unique, right? So, exactly. Another topic that is quite popular and we receive a lot of questions about is inheritance, particularly if you're a Canadian resident and you expect to, or you have recently inherited U.S. assets, whether that's a U.S. registered account like an IRA, whether it's a house, whether it's other non-registered assets. Maybe I'll start with you, Gary. What are some general things people in that situation need to be aware of, and how do they start understanding their obligations there?
Usually in these scenarios, a person's inheriting something from a relative or a friend who lives in the United States who is a U.S. citizen. So people always have the first question that always comes to mind is, do I have to pay estate tax? I inherited these U.S. assets from a family member in the U.S. And the answer would be no, because it's the estate's issue in the United States, not yours. That being said, for example, you talked about retirement accounts. That's always a very interesting one. We see that all the time, where the person the beneficiary of the account is actually a Canadian with no U.S. ties. And it's not an issue for them to inherit it, but it can be a little bit tricky stick handling with RJLU, which is our U.S. branch. And most of the time, what I've seen is we have Canadians who have to apply for a U.S. ITIN, a U.S. identifier number, before the account can be opened, because there needs to be tracking of required minimum distributions, and that's a primary problem that we tend to see. The other issue that we do see is people inherit real estate in the United States. And basically, for Canadian and U.S. tax purposes, they inherit that real estate at the fair market value at the time the person passed. So these are the most common assets that people inherit.
Sam, do you have anything to add to that from your experience and what you've seen lately?
Yeah, just to add to Gary's points, I would say it's also important to consider some states in the U.S. actually have an inheritance tax. So depending on which U.S. state you have, there could be an additional layer of inheritance tax imposed at the state level. So it's important to sort of understand the different laws and whatever state the assets are located in.
Exactly. There's probably a lot more we could talk about in that general topic, but I think I'll move on and just close out here. I know tax is not the most riveting thing for a lot of people, so I don't want anyone to fall asleep. Getting started and just some practical advice. If someone thinks they have cross-border tax exposure or they're worried about having reporting obligations, what's their first step? How do they start learning about that and taking care of getting their ducks in a row, so to speak? Maybe I'll ask that of you, Gary.
Can you just repeat the question? I was distracted by background noise.
Oh, no worries. I was just asking in general for someone who thinks they might have U.S. Some cross-border tax exposure and some reporting obligations, and they have little to no understanding of what that entails. How would they get started in dealing with that?
Oh, that's a very broad question,
It is.
Lee. I would say this: approach your accountant if you have one here domestically, first of all. But my concern with saying that is most Canadian accountants know nothing about it. And so that's where people need to really do their homework, perhaps go online and say who in my area knows anything about this, who really knows something about this, and then contact that person and say, hey, this is my situation. And I think I might be exposed to U.S. tax. I'd like a consultation. Sometimes people are, sometimes they're not. The U.S. is not as scary as people think. It can be dealt with. But again, it depends on what's going on. Everything is fact specific. There's no cookie cutter answer here for any of these questions.
That's exactly right. Like our group has been cross-border licensed for over a decade, and everything's unique. Not everything's different, but we never see the same thing twice, really. So, Sam, I'll ask this of you. So let's say someone moves, they get all of their whole situation compliant and everything's fine. How often should people review their cross-border tax exposures and conduct plan updates and just keep an eye on everything? How closely should people monitor this?
I would say at minimum on an annual basis, it would make sense to sort of review your financial plan, review your tax returns by trusted cross-border experts, either financial planner or tax accountant. And again, whenever if you have a large taxable event that's going to happen, let's say you have some stock options you're getting from your company or RSUs, or if you're selling a property and you have a large taxable event or an inheritance, or let's say you're retiring, in the near future, or those are all sort of events where you'd want to sort of revisit your financial plan and see if there's any planning opportunities that could be taken, before that event happens to minimize your potential tax burden. And, ideally, if you're moving to either Canada or the US, you want to do that, several months ahead of time. So any planning can be done in the current tax year as opposed to, waiting till the next year when it might be too late.
Right. This has been great. Final question, same question for both of you. Any parting advice for someone planning a move or has already moved? Any last minute thoughts? Maybe Gary, I'll start with you.
Don't wait until the last minute to deal with things. That would be my advice, because too often I've seen people come to us after they moved, and it's hard to really help people when there are steps that you can take prior to your move to make your tax situation better.
Yeah, that's great advice, Gary. I would just add to that, do your homework, read up the necessary rules. Nowadays, a lot of clients are, going on, ChatGPT or Copilot and trying to do some research. And a lot of times the information online is not always up to date. So you really have to work with a good cross-border professional that's up to date with the latest rules and has a lot of in-depth experience dealing with these situations. So do your homework and speak with the right advisor that can help you.
And do not over rely, to Sam's point, on AI. AI spits out answers quite often based upon what you ask, or as Sam mentioned, outdated information. So you have to really understand the topic to interpret what AI is giving you. And most people cannot do that on their own.
That right there is a great point. Sorry, there's a fire alarm here. That's a great point. I think you're exactly right. I think people are, especially these days, people are relying more and more on those AI chatbots. I think there will come a day where they're a lot more reliable, but for now, I think it's really important to speak with folks like yourselves. Sam, Gary, really appreciate this. I think the clients and the audience that watches this will get a lot of value out of it. Look forward to doing this in the future. I expect we can dive a bit deeper on some of the specific topics. For now, I'll wrap it up. And thank you again. Really appreciate this.
Thank you. Have a good day.
No problem, Lee. Great chatting.